Let's imagine you're sitting at your desk in the office and a new prospective home buyer walks in the door. They've heard mortgage loan interest rates are low and they want to buy a home. How do you guide this would-be buyer with directions? Another common situation involves the home buyer who is determined to buy a dream home and is ready to look at a number of properties for sale. They have yet to speak to a lender to determine their budget range. How do you provide them with guidance on which homes fit their budget? Still, other instances arise when investors want their agent to help them find the best home to flip using a low-cost interest rate loan. They want advice on the best type of loan for their unique situation. Real estate financing is responsible for most purchases today. As an agent, you must understand not just what the current rates are, but also what the options for borrowers are in any given circumstance. To get started, we need to focus on the heart of the system, the Federal Reserve System. Understanding the Federal Reserve System. The Federal Reserve System, commonly referred to as the Fed, is the banking system within the United States controlled by a central board of governors called the Federal Reserve Board. This federal bank has 12 geographical districts. It has significant control over a variety of financing sectors, including credit and the amount of money in circulation. This national bank plays an important role in the real estate financing sector. It creates various rules that govern how, when, and why lenders lend money. When your clients come in to buy a home, whether they realize it or not, the amount of funding available to help them purchase that property is directly controlled by the actions of this bank. The regional reserve banks do most of the work for the Federal Reserve. They impact the interest rates your clients pay for a mortgage. This is done through the Federal Open Market Committee, FOMC, which is a section of the Fed. This committee meets 8 times a year or whenever there is an economic concern. A key component of the work they do is to set the target lending rate. This is the interest rate charged when banks lend their deposits to other banks overnight. This is done to keep the banks within their reserve requirements. The impact here to the real estate market is a bit less complex. In short, banks are charged this key interest rate by other banks. To make their profit, banks must increase the rate they charge their clients, your home buyers, when lending money. Changes in the interest rate paid by home buyers, in part, stems from the changes made by the Federal Reserve then. To spur lending, the Fed recently dropped the interest rate significantly. As a result, banks had more money to lend borrowers, including home buyers. The bank may tighten up or increase this rate, on the other hand, to minimize inflation. The Fed impacts 2 main marketplaces where loans are bought and sold. The primary mortgage market is the main market in which loans are originated. Your home buyer will turn to a bank to secure a loan. A financial institution underwrites the loan. This is the primary market. The secondary mortgage market is the market where lenders can sell those loans to secondary agents. This includes the Federal Home Loan Mortgage Corporation, Federal National Mortgage Association, and the Government National Mortgage Association. Let's take a step back and explain what each of these organizations are and how they work. First, consider the primary mortgage market. The primary mortgage market is where mortgage originators and borrowers come together to discuss the terms of the mortgage and to put the mortgage loan into place. This market is where mortgage brokers, credit unions, traditional banks, and mortgage bankers work together to connect with the borrower. In most situations, such as a homebuyer requesting help with obtaining a loan, you will need to point your borrower towards a member of the primary mortgage market. Real estate agents generally do not negotiate terms for borrowers, but they can make recommendations. Once a loan is originated in this market, it is then most commonly sold to the secondary mortgage market. This happens behind the scenes, with most borrowers not having any knowledge of it occurring. Next, consider how the second mortgage market works. Now, the secondary mortgage market is a bit more complex, but it's important to understand what is likely to happen to your borrower's loan once it secures origination. Generally, by the time your homebuyer has moved into his or her home, the originator of the loan is already moving it to a secondary mortgage market. This market is made up of mortgage originators, the mortgage aggregators, also known as securitizers, and investors. This market is very large. It is also very liquid, meaning investments are sold frequently between these individuals. Once a loan is originated, it is then packaged with other recent loans to create mortgage-backed securities. These securities are sold to pension funds, hedge funds, or insurance companies, all of which are investors who hope to profit from buying and selling the packages. In a roundabout way, this market is what makes it possible for credit to be available to all people across the country. Without it, your borrower in a low-income area may find it hard to secure a loan from a small lender. What about Fannie Mae, Freddie Mac, and Ginnie Mae? If you've heard these names and wondered who these people are, realize that they are not actually people, but rather investors within the secondary market. We've mentioned them before when discussing the Federal Reserve, but let's talk about each one of these a bit more individually. It's important to understand this because some types of loans your borrowers may want, such as FHA loans for first-time homebuyers, are often backed by these investors. The Federal National Mortgage Association, or Fannie Mae, is a company listed on the New York Stock Exchange. This is a public company that works under a federal charter. What's most important to know is that it is the largest financial backer of mortgages in the country. However, homeowners are often confused by this. Some may request a loan through Fannie Mae. The organization does not lend directly to the borrower, but due to its investment strategies, it is able to make sure mortgage funds are available at affordable rates. Freddie Mac, or the Federal Home Loan Mortgage Corporation, is another independent company operating on the stock market. It invests in conventional mortgages as well as FHA and VA loans. FHA and VA loans are an important tool for today's borrower. This federally backed program protects investors from borrower default and reduces interest rates and down payment requirements to borrowers. In short, FHA and VA loans are what you'll most likely talk about to your home buyers if they are first-time home buyers or home buyers that were a member of the Armed Forces of the United States. Finally, Ginnie Mae, or the Government National Mortgage Association, is a government-owned company that's structured within the U.S. Department of Housing and Urban Development, more commonly known as HUD. This organization guarantees mortgage securities, or packages as we've referred to them here, that are backed by other government agencies. Now, to wrap up, let's talk about how a real estate agent fits into this puzzle. As a real estate agent, you won't be involved in either the primary or secondary markets. However, your homebuyer views you as the expert in the home buying process. For this reason, it pays to keep up to date on the market and its changes. If the Fed plans to increase interest rates, you may want to encourage would-be homebuyers to lock in a loan rate now before that happens. When a borrower comes to you to request help finding a home without loan approval, you'll want to recommend they do that as a first step. And, of course, as conditions change, it can impact how much the borrower can purchase based on interest rates. As an agent, it's important for you to be mindful of changes within this industry, as it plays a role on how many people are in the market, as well as what they are likely to be able to afford.